Hi, I'm Grant Abbott, and today we're talking about the tax exemption for segregated current pension assets in a superannuation fund. For many years, in fact, from 1994 to probably about the mid-2000s, generally segregated current pension assets, or the ability to get a pension exemption for assets set aside solely for pensions, wasn't available. The accounting and office systems for self-managed super fund administration really didn't allow it very easily. But with new cloud-based systems, it's fairly easy to set aside or segregate assets for purely pension members or transitional retirement income stream members. Now, of course, with that exemption, there's obviously a great lot of possibilities. Being able to set aside a separate asset and any income or capital gain flowing from that asset is completely exempt from income tax and also capital gains tax. However, that has obviously brought the Commissioner's, I suppose, binoculars down on what a pension is, or when does that exemption actually apply. There's been a number of rulings and also determinations released along that. So let's just go through that fairly quickly. First off, when does a pension commence? Well, the key document to find out when a pension commences is generally going to be the trust deed. You'll find that the trust deed, if you're using the SMSF Strategies trust deed, the pension commences when the member applies for a pension, and then the trustee then commences the pension, and in there tells the start date as to when that pension actually starts. If that's the case, then that is actually when the pension commences. Of course, all the capital needs to be set aside inside that member's pension account in order to start that. We can't do a top-up after the commencement date. If you try to do a top-up, then that means that pension is no longer, and it means we've refreshed the pension, or to the Commissioner's terms, taken it back to the accumulation side and then set in place a brand new pension, which means there's going to be a break in the tax exemption. But more importantly, probably a lot of the rulings are around when a pension ceases. You see, when a pension ceases or it stops, what happens there is it then folds back to the accumulation side and you lose your tax exemption. That's particularly important on death. The government's looking at making a number of laws around that. We haven't seen them for a while, but again, those laws are pretty pathetic or useless unless your deed coincides with those laws, keeps that pension open so the new capital gains tax laws apply. Worst case is that, and I've seen this probably in around about 90% of trust deeds, is that when a member dies, they are no longer a member of that fund. So those extension laws, the ability to keep that pension going on, is meaningless in those trust deeds, where if a member dies, their membership ceases, because at that point in time the account is closed, and effectively from the Commissioner's point of view, it all goes back to the accumulation side. So the number of other instances when a pension ceases is when it doesn't meet the requirements of SIS Regulation 1.061 and also 1.069A. In those instances, if a minimum pension is not paid during an income year, that pension ceases, and under the Commissioner's ruling, it goes back to accumulation, and then if you set it up again, or you go back to paying the minimum, a brand new pension is then commenced. So that creates its own problems, because to create a new pension when the deed may say that it's able to be continued on is fairly problematical. But again, this is what the Commissioner said. He said it applies back from the 1st of July 2007, but because of the potential reassessments of funds, he's only going to apply it from the 1st of July 2012, or to the 2012-2013 income year. So all of any accountant or administrator or planner that's got clients in administering needs to scratch their head and make sure they've done the right thing. The client has paid a minimum pension. As I said, another element is where there's a commutation of a pension, where a lump sum is actually taken out of that pension, or the pension's closed down. You've got to be really careful for this one, because the Commissioner says when you pull that money out, effectively the pension ceases. So unless you're pulling it out a minute before the pension ceases, which is virtually impossible, it's all going to go back to the accumulation side, and there's going to be capital gains tax, which is fairly dire consequences. The better thing to do is, again, he says, with a partial commutation, pulling an amount out of the superannuation fund and leaving maybe $2 or $3 inside that fund, in that pension account, that would still mean that the monies are coming out of the pension side of the fund. We've still got the pension open. If we take those other $2 or $3, when I mean that, I mean $1,000 or $2,000, if we take that out at a later stage, effectively that is going to be treated as being on the accumulation stage. So these are fairly important rules for us as to when a pension ceases. You really have to make sure that your governing rules are really spot on. The best thing to cover it, which the Commissioner says, is if you don't want to worry about this going back, simply do an auto-reversionary pension. For those who have been using our SMSF Strategies Trust Deed, that's been stock standard for us for many years. Our account-based pensions come with auto-reversionaries. You can either order them directly for SMSF Strategies, or if you're a NowInfinity member, they're automatically included as part of your 40 document package. So it's fairly crucial. Deed, the actual documentation being the pension, join those together, you're not going to have problems with tax exemption. If you don't, you're going to find that you might, halfway through a year, you may well find that you're no longer in the pension side but in the accumulation side, which creates absolute nightmares in terms of accounting, administration and more importantly tax. So pensions are important. And the final one, the Commissioner issued a determination that where someone has an asset which has got a fairly large gain on it, then they set up a transitional retirement income stream or a pension and then sell that asset shortly thereafter. The Commissioner said he may use the anti-avoidance rules around those. So just be extremely careful around that. Give yourself some time, otherwise there may well be a legal case on your hands. If anyone at all gets into trouble regarding audits, needs a ruling, or there's litigation taken up by the tax office, we've got a fairly strong legal team that can help you guide your way through it. In fact, we had the senior tax litigator from the tax office, Tanya Waterhouse, now working with us. She can really help in getting rulings, or if there's any litigation, making sure that we can get that through the AAT. Anyway, that's enough of that. Pensions, just be really careful. Anyway, it's Grant Abbott signing off.